Day 43. First question. The Fisher equation tells us that the real interest rate approximately equals the nominal rate minus the inflation rate. Suppose the inflation rate uh, increases from 3% to 5%. Does the Fisher equation imply that this increase will result in a fall in the real rate of interest? Explain. No, this does not mean that there would be a definite fall in the real interest rate, because the central bank, to combat this, will increase the nominal interest rate by an approximate amount such that it can counter the increase in inflation, and therefore there won't be a definite fall in the real interest rate. Question number 2. You've just stumbled on a new dataset that enables you to compute historical rates of return on US stocks all the way back to 1880. What are the advantages and disadvantages in using these data to help estimate the expected rate of return on US stocks over the coming year? Advantages and disadvantages of long-term historical data since 1880. Advantages provides a very long sample capturing many different economic regimes, wars, depressions, bull markets, high/low inflation periods, which may give more robust estimate of the long run average return on risk, reduces sampling error relative to shorter data sets. Disadvantages: non-stationary. The fundamental economic environment, market structure, and composition of US stocks have changed dramatically since 1880, making past returns potentially poor guides for the future expected return. Survivorship bias. Early data may exclude failed companies or exchanges, overstating historical returns. Changing risk profile. The equity risk premium may not be constant over such a long period. Short-term estimation. For estimating the expected return over just the coming year, long-term historical averages are of limited use because short-term returns are dominated by current valuations, economic conditions, and investor sentiment, which differ from long-run averages. Third question. You are considering two alternative 2-year investments. You can invest in a risky asset with a positive risk premium and returns in each of the 2 years that will be identically distributed and uncorrelated. Or you can invest in the risky asset for only 1 year, then invest the proceeds in a risk-free asset. Which of the following statements about the first investment alternative compared to the second are true? 2-year risky investment versus 1-year risky plus 1-year risk-free. Given risky asset has positive risk premium, returns in each of the 2 years are identically distributed and uncorrelated. Compare alternative 1, invest in risky asset for 2 years. Alternative 2, invest in the risky asset for 1 year and then invest the proceeds in a risk-free asset for the second year. Analysis. Let risky asset in 1 year be equal to R. Let risky return in 1 year be equal to R. Mean equals to mu, variance equals to sigma square, risk-free return equals to R underscore F, and risk premium equals to RP equals to mu minus RF, which is greater than 0. Mu is the mean return, RF is the risk-free rate. So we are saying that the mean return in the risky asset in 1 year is more than the risk-free return, in simple words. For alternative 2, risky then risk-free, the 2-year return is 1 plus R into 1 plus RF. For alternative 1, risky for 2 years, the 2-year return will be 1 plus R1 plus 1 plus into 1 plus R2, where R1 and R2 are identical. Independent and identically distributed, IID. Evaluating the statements about alternative 1 compared to alternative 2. It's a 2-year risk premium, same as second alternative. Okay, so these are statements. Statement A, it's a 2-year risk premium, is the same as the second alternative. False. The 2-year risk premium for alternative 1 is approximately 2 into RP plus RP squared. while alternative 2 is approximately RP. Second statement, the standard deviation of its 2-year return is the same. False, the standard deviation of the 2-year return for alternative 1 is higher because both years are risky. For alternative 2, the second year is risk free, so the total volatility is lower. Statement 3, its annualized standard deviation is lower. False, the annualized standard deviation for 1 is sigma, annualized of risky asset. For alternative 2, it's lower than sigma because second year is risk free. So therefore, the second alternative has a lower standard deviation. Fourth statement is its Sharpe ratio is higher. False, the Sharpe ratio is risk premium per unit of risk. So it's basically risk premium theta divided by sigma. I think risk premium was theta. I might be wrong. I'm pretty sure it was. Yeah. False Sharpe ratios, risk premium. Okay, while alternative 1 has a higher 2-year risk premium, alternative 1 has a higher 2-year risk premium. It also has a disproportionately higher 2-year standard deviation. Given that the 2 years are uncorrelated, the 2-year variance for alternative 1 is higher, and the increase in risk is typically outweighs the increase in premium, leading to a lower Sharpe ratio compared to alternative 2. Fifth statement, it is relatively more attractive to investors who have lower degrees of risk aversion. True, our alternative 1 offers higher expected return but with higher risk. Investors with lower risk aversion are more willing to accept the additional risk for extra expected income. Okay, question number 4. You have $5,000 to invest for the next year and are considering 3 alternatives. Statement A, a money market fund with an average maturity of 30 days offering a current yield of 6% per year. Statement B, a 1-year savings deposit at a bank offering an interest rate of 7.5%. Statement C, a 20-year US Treasury bond offering a yield to maturity of 9% per year. What role does your forecast of future interest rates play in your decisions? So you have 5,000 to invest the next year. Money market fund with average maturity 30 days, 6% per year. Okay. Answer 5. Effect on real interest rates. Use supply demand for loanable funds framework. Statement A, businesses reduce capital spending. Oh, sorry. One sec. My bad. Sorry. Answer number 4. That's the fourth question. Your forecast of future interest rates is critical because each investment has a different interest rate risk and reinvestment risk. Alternative A, money market fund, very low risk but yield will fluctuate every 30 days. Forecast of rising rates makes this attractive as you can reinvest at higher yields soon. Forecast of falling rates, vice versa. Alternative B, 1-year bank deposit rate is locked for 1 year. If your forecast rates will rise, unattractive. If it falls, attractive. Alternative C, 20-year treasury bond, very sensitive to interest rate changes. Forecast will rise, bond price will fall, leading to potential capital loss. Forecast falling rates, the bond offers capital gains additional to the 9% yield, making it very attractive. Thus, your rate forecast directly impacts which alternative offers the best risk return trade off for your 1-year horizon. Question number 5. Use figure 5.1 in the text to analyze the effect of the following on the level of real interest rates. Businesses become more pessimistic about future demand for their products and decide to reduce their capital spending. Uh, Decrease in demand for loanable funds, less investments, demand curve shifts left, leading to a decrease in real interest rates. Statement B, households are induced to save more because of increased uncertainty about their future social security benefits. Households save more, increase in supply of loanable funds, supply curve shifts right, leading to a decrease in real interest rates. Option C, statement C. The Federal Reserve Board undertakes open market purchases of US Treasury securities in order to increase the supply of money. The Fed open market purchases to increase money supply. This is a monetary policy action that initially lowers nominal rates. In the short run, it can also lower real rates if prices are sticky. In the loanable funds framework, the increased money supply can lower the nominal interest rate, which, if inflation expectations are unchanged, lowers the real interest rate. Question number 6. You are considering the choice between investing $50,000 in a conventional 1-year bank CD offering an interest rate of 5% and 1-year inflation plus CD offering 1.5% per year plus the rate of inflation. Statement A, question A, part A, which is a safer investment? Depends on the expected inflation. Conventional CD versus inflation plus CD. Safer investment, the inflation plus CD is safer in real terms because it guarantees a real return of 1.5%, preserving purchasing power regardless of inflation. The conventional CD exposes you to inflation risk. Higher expected return, cannot tell. The expected return on the conventional CD is 5% nominal. The expected return on the inflation plus CD is 1.5% plus expected inflation rate. If the expected inflation is about 3.5%, the inflation plus CD offers a higher expected nominal return. If below 3.5%, the conventional CD does. Part C, if expected inflation is 3%, conventional CD is real return is 2%, inflation is 1.5%. The conventional CD is better because it offers higher expected real return, 2% greater than 1.5%. Part D. If you observe a risk-free nominal rate at 5% per year and risk-free real rate of 1.5% inflation index bonds, can we infer that the market's expected return of inflation is 3.5% per year. According to the Fisher equation, nominal rate is approximately real rate plus expected inflation. Given nominal risk-free rate 5%, real risk-free rate 1.5%, then expected inflation equals 3.5%. Yes, we can infer this assuming the bonds are comparable in terms of risk, liquidity, and maturity. Question number 7. Suppose your expectations regarding the stock prices are as follows. States of the market boom, natural nominal growth, recession. Mean and standard deviation of the HBR, holding period return on stocks. Mean, expected return. ER equals to summation of PI into RI. 0.35 into 1.31 to 0.445 plus 0.3 into 0.14 0.35 into minus 16.5, which is equal to 14%. So we just multiplied the probability and the HPR respectively and added all them up cumulatively to get 14%. Variance equals to 0.35 into 0.445 minus 0.14 whole square plus 0.3 0.14 minus 0.14 whole square plus 0.35 star, okay, which equals to 0.065117. Standard deviation equals to root of variance, root equals to root of 0.065117, 25.52%. Question number 8. Derive the probability distribution of 1-year HPR on 30-year US Treasury bond with an 8% coupon index if it's currently selling at par, and the probability distribution of its yield to maturity a year from now is as follows. States of the economy: boom, natural growth, and recession. Take a little bit of a break. Wash my face. Anyways, thanks.